Welcome back, everyone. Okay, today we've got a seriously fascinating explainer lined up for you. We are going to completely and objectively unpack the massive hype and the incredibly aggressive Wall Street targets currently surrounding Credo Technology Group, ticker symbol CRDO. If you've been following the semiconductor and AI infrastructure space even a little bit, you have definitely seen this name flashing across your screens. But today, we're going to look past the headlines, right? We're going to dive into the hard data, the financial metrics, and the technical analysis straight from our sources to figure out exactly what's driving this narrative, and perhaps more importantly, what hidden risks might be lurking right beneath the surface. So let's dive into this. So the big question floating around right now, is CRDO the next massive AI runner? Because right now there is this intense tug of war happening. Over the past few weeks, the stock has been swinging wildly. Bouncing between the mid-160s all the way up to above $210. Momentum traders are out there actively defending those dips in the 150s, which tells us buyers are eagerly stepping in. But there's a really distinct tension here, you know? We have this current trading range, and then we have the absolute sky-high expectations being set by the market. So let's take a look at exactly what the analysts are projecting that is fueling this whole frenzy. What's really wild here is the sheer level of conviction coming out of Wall Street. For instance, Rothschild & Co. Redburn recently launched coverage on Credo with a buy rating and a massive $206 price target. And they are definitely not alone here. This actually just reinforces an already incredibly bullish analyst crowd. The average consensus price target is sitting even higher at $212.16. Firms like Jefferies have even gone as far as adding CRDO to their high-conviction franchise picks list. Now, this kind of heavy institutional backing, it usually acts like a magnet for larger pools of capital, essentially serving as a launchpad for the stock. But what is the actual fundamental story they are buying into? To really get why everyone's so hyped, we need to zoom out a bit and look at the macro megatrends driving Credo forward. The company is basically sitting right at the intersection of artificial intelligence infrastructure, 5G, and massive data center expansion. But the absolute crucial point, the real catalyst here, is the shift from copper to optical networking. Look, as data centers desperately try to bulk up their capacity and speed just to handle the insane demands of generative AI, they are literally hitting physical limits with traditional copper wiring. Credo is aggressively positioning itself as the premier supplier of the high-speed, energy-efficient connectivity needed to solve this exact bottleneck. It's an incredibly compelling story. But you gotta ask, do the numbers actually back it up? Well, yes, they do. Just look at this number, 226%. That's not a typo. That is Credo's explosive revenue growth over the last 12 months. This right here is exactly why momentum traders are flocking to this name. It is the ultimate story plus numbers stock. They aren't just out there selling some pipe dream of a future AI landscape. They are actively capturing the market right now, translating that whole copper to optical shift into triple-digit top-line growth. It's a staggering figure that absolutely justifies the heavy attention the stock is getting. But as we know, revenue growth is only one half of the income statement. What happens when we look at the bottom line? Let's look at how this builds the fundamental case. Credo isn't just growing fast. They are highly profitable while doing it. Check out these last 12-month values. An operating margin of 30.3%. Cash flow from operations sitting at 31.8% of revenue. And an incredibly healthy free cash flow margin of 26.6%. Honestly, in the high-growth tech sector, it is remarkably rare to find a company expanding its revenues at over 200% while simultaneously printing this kind of cash. It basically proves they're executing efficiently and turning that shiny AI narrative into real, tangible dollars in the bank. And all that cash flow generation, it has resulted in a literally pristine balance sheet. Credo boasts zero total debt. Zero. And they have a massive war chest of $1.3 billion in cash and equivalents. Their current ratio, which, if you remember, measures their ability to pay short-term obligations, is a whopping 10.8. So the takeaway here is that they have total financial flexibility. They can heavily fund their aggressive R&D to stay ahead in this incredibly tight optical networking race, and they can do it without relying on expensive leverage or outside debt. Structurally speaking, the foundation here is rock solid. All right, so we've established the megatrends, the explosive growth, the fat margins, and the flawless balance sheet. Sounds like a dream, right? Perfect. But in the stock market, you always have to ask, what is the cost of this growth? You very rarely get to buy a perfect financial profile for cheap. So we need to shift our analysis from the fundamental business performance over to the valuation layer. Exactly how much of this flawless future AI success is the market already pricing in today? And here is the ultimate dilemma for anyone looking at Credo. On one side, you have the undeniable pros we just went over, but on the other, you have staggeringly expensive valuation multiples. We are talking about a price-to-sales ratio of 29.1 times. Let that sink in for a second. The market is valuing the entire company at almost 30 times its actual revenue. Plus, the price-to-earnings ratio is sitting way above 90 times, and their price-to-free cash flow is nearly 110 times. These are extreme premium multiples that price in a tremendous amount of flawless future execution. Any slight miss, any tiny hiccup in upcoming earnings reports could easily trigger some very sharp, volatile reactions. But honestly, despite that sky-high valuation, the hype machine is just running at full capacity right now. A 7-day news sentiment analysis actually carries a very bullish overall score of plus 4.5 out of 10. Out of the recent articles analyzed, 70% were strictly positive, mostly hyping up that AI connectivity demand, and absolutely zero were categorized as bearish. None. The media cycle and momentum traders are just feeding this narrative in a massive feedback loop. And as you've probably seen before, when expectations and sentiment run this hot, a stock can completely defy traditional valuation metrics for quite a while, just floating on the promise of the AI revolution. Section Red Flags and Hidden Risks. Let's take a look. Because as objective learners, we can't just stop at the bullish sentiment. We have to peel back that final layer and look straight at the hidden risks lurking underneath that AI premium. And the absolute most glaring red flag, extreme customer concentration. According to the data, a single customer is driving the vast majority of Credo's revenue. Now that is a massive structural vulnerability. Think about it. If that one customer decides, hey, we're going to change technologies or negotiate lower prices or jump to a competitor, poof, that 226% growth rate could literally vanish overnight. Add to that their limited scale compared to massive, heavily funded semiconductor rivals, plus a pretty high share-based compensation eating up 15% of their revenue, and you start to see the actual structural cracks in the bull thesis. There's also another little wrinkle in the data: recent insider activity. The chief technology officer recently sold off 27,500 shares, cashing out roughly $5 million. Now, I know some traders instantly view insider selling as a massive flashing red alarm, but we have to contextualize this objectively. The selling occurred while the stock was pushing to new highs, and much more importantly, the CTO still holds over 6.1 million shares, so he still has intense skin in the game. To me, this looks a lot more like routine profit-taking rather than some desperate rush for the exits, but it is definitely a data point worth monitoring given the stock's extreme valuation. Finally, we gotta talk about the technical setup, because timing is everything. A recent backtest actually shows a historically low 40% win rate for the stock based on its trading patterns. Furthermore, the analyst report gives the current technical setup a confluence score of exactly 0 out of 7. Yeah, 0. It's showing a weak trend and bearish moving averages in the short term. The intelligence strategy outlined in our sources suggests a hold for now. This indicates that, hey, despite the amazing revenue growth, you might want to wait on the sidelines for a much stronger, confirmed technical entry signal before jumping in. And that brings us to our ultimate takeaway. You've got this company perfectly positioned in the AI megatrend. They are printing cash, zero debt, and seeing triple-digit growth. But you are being asked to pay a 30-time sales multiple for a business that is dangerously reliant on a single major customer. So I want to leave you with this question to chew on. Is the explosive upside of the AI infrastructure boom truly worth absorbing that extreme customer concentration risk at this valuation? It is a fascinating standoff between incredible fundamentals and real structural danger. Thank you so much for joining me today, and as always, keep learning.